Hey, soldiers, the banking industry is facing some incredible challenges, and we're going to go over those. In addition, JP Morgan just made one hell of a mistake that is costing it big. Should you consider taking all of your money out of the bank and just maybe putting it in the house for safekeeping until we figure out how the banking industry shakes out? Well, we're going to go over it. Let's first start with Christopher Whalen. Now, Christopher Whalen is the head honcho over at Whalen Global Advisors. They're a firm based in New York. They do all kinds of financial risk analysis. And he came out just a little while back, and he had some interesting things to say about the banking industry that should give you pause, but should it cause you to, act in an apoplectic manner and just panic and take all your money out of the bank? Well, you tell me. Basically, what he did was looked at the global banking arena, the whole kit and caboodle, and said that they've got about $2.2 trillion in assets held by banks globally. Now, he's saying at first blush, they could lose a lot of that and result in having only $1.5 trillion in assets when you account for the fact that banks haven't updated the value of their bond portfolios. If you take away things like Goodwill. What is Goodwill? Well, let's take JP Morgan, for example, since we'll be talking about them and their huge mistake they made. Okay, this amateur mistake they made. We'll talk about that in a minute. But Goodwill could be considered the brand, JP Morgan. That's a globally recognized brand. They've been out there since in some form or fashion. They can date their history back to 1799. That's significant, okay? That carries a lot of goodwill. You can think of the Coca-Cola logo as goodwill, okay? Goodwill is something that it's not really, you can't really place a value on it by itself. But in any event, if you take away all of that, you take away deferred assets, then the banks are not holding $2.2 trillion. They're holding $1.5 trillion. Then, if you account for the fact that they haven't updated their bond portfolios by and large, we're looking at assets of $1.2 trillion. But here's where it gets interesting. When you look at these stocks, like remember the FANG stocks? They were so hot. Facebook, Amazon, Netflix, Google. Okay, these were the hot stocks back just 18 months ago. Well, the FANG stocks have taken a beating, and a lot of banks held shares in these companies. So, for example, if you take Facebook, the F in FANG, they're down 24% over the 5-year period. They're down a whopping 56% over the 1 year. Amazon has lost almost 40% of its value in the last 12 months. Netflix is down 35%. And Google is down 32% over the past year. So the banks that have held, and a lot of banks hold these shares in these types of stocks. When you start accounting for the losses in their stock portfolio, you're looking at negative 500, actually you're looking at negative $500 billion in assets, okay? Then when you look at all the banks that hold these U.S. treasuries and the fluctuations there, we go from 2.2 trillion on the positive side to 1.3 trillion in losses that these banks could be facing. Now, here's the important caveat. It's just like when we've come on here and we've said to the audience in the past, if you're holding a stock and the stock is down 50% in the last year, well, you don't realize that loss until you sell. You never know, it could come back. If you look at the stock of almost any Fortune 500 company, you'll see some wild fluctuations over time, especially during periods like 2000 and the dot-com bubble, 2001 when we had the tragedy occur, then again in the Great Recession, okay? So you don't realize the loss unless you lock it in by selling. Banks pretty much have the same kind of scenario working in their favor. But to the extent that any bank cannot hang on and does need to sell assets, that might be a huge problem for them. Now, speaking of huge problems, JP Morgan, I can't believe they let this get by them, but they did, I can assure you. Some people have lost their jobs at JP Morgan. But would you believe another millennial, okay, Sam Bankman-Fried mold, sold her company to JP Morgan for $175 million. She teamed up with a professor to create 4 million fake accounts to scam the finance giant, emails show. All right, and the Latin says, caveat emptor, let the buyer beware. Sometimes even the most financially savvy business can get suckered in by hoaxers. And Jamie Dimon, CEO of JP Morgan, looks like this happened to him. Our old buddy, JP Morgan, fell into quite the trap recently when the finance giant purchased a company for $175 million, and it turned out that the company's owner sold it based, allegedly, on false information. A fintech, for those of you from West Baltimore, fintech means financial technology. A fintech startup bought by JP Morgan Chase for millions may have been built on a bed of lies, according to a new lawsuit filed by JP Morgan. And if the investment bank is to be believed, it all went wrong with an $18,000 check to a New York City area data science professor. Now, look, they're not just an investment bank. They're also a retail bank. They've got Chase, and Chase is everywhere, but you might have an account there. So this is just one organization here. On December 22nd, JP Morgan filed a lawsuit against Charlie Javis, the millennial founder of student aid facilitating platform Frank, and the company's chief growth officer, Oliver Amar, claiming the pair fabricated around 4 million non-existent accounts that they said used their service, which JP Morgan purchased for $175 million in September of 2021. The investment bank shut down Frank in early January of 2023, weeks after the suit was first filed. The bank maintains in its lawsuit that while it had been expecting to purchase a business, quote, deeply engaged with the college-aged market segment, unquote, with over 4 million users, what it actually received was a customer list containing no more than 300,000 accounts. So look, I will be straight up with you. In the interest of full disclosure, I have shares in JP Morgan, have for quite some time. And this is the kind of due diligence that you need to do on an ongoing basis. You can't just do your due diligence one time. You got to keep your finger on the pulse of anything you own and are expecting to generate a return and or profits or income rather for you, which we expect a stock to do. We expect it to appreciate. And of course, if it is a dividend paying stock like JP Morgan is, then we also expect some income. And we expect that income to, at best, continue unabated. We don't want to see a drop in it. In the best case scenario for that income piece is we want to see that dividend go up. Now, at worst case, we definitely don't want to see a decrease. And anytime a bank starts losing money wholesale, that can threaten that dividend as well as the appreciation of the stock. Okay, but JP Morgan is alleging that in 2021, when the bank and Javis first discussed an acquisition, Frank was, quote, almost 4 million customer accounts short of its representations to the bank. To make up for the deficit, before presenting Frank's official customer account data to JP Morgan for due diligence, the bank claims that Javis and Amar turned first to the platform's unnamed director of engineering to create, quote, synthetic data, fake data, a fraud, fake customer information generated by computer algorithms. All right, but this person, whoever they were, the person that would have, been in charge of actually doing this, the director of engineering, said, hell no, I'm not spending a day, a minute in a federal prison. According to JP Morgan's lawsuit, that engineer felt uncomfortable, asking, quote, whether the request was legal, unquote, and eventually declined. So Javis and Amar allegedly resorted to an external source referred to merely as, quote, a data science professor at a New York City area college. Now, kudos to that engineer who said, nah, man, this is just, it doesn't smell right. You guys are asking me to perpetrate a fraud here. I would not be surprised if we saw federal charges filed at some point. Because remember, if you are defrauding some company or you're misrepresenting facts, there could be, I'm not a lawyer, but there could be some, liability here from a criminal standpoint. And JP Morgan's a publicly traded company. Did this information cross state lines? The feds will figure it out. I think we can expect federal charges coming here soon. But still, JP Morgan has egg on its face. Now, when crafting the new customers' names, the professor, 4 million names. When crafting the new customers' names, the professor allegedly emailed Javis with a proposed model to weed out real people's names by testing first the last names independently to, quote, ensure none of the sampled names are real, unquote, because, real people would say, hey, no, I didn't sign up for that. And the scheme would have been discovered a lot quicker. In another email, the professor allegedly noted how many of the account's personal information histories were the same, including an unnatural rate of reoccurrence for high school names and hometowns. Such a list would, quote, look fishy to him if he were to audit it, unquote, the professor wrote. When it came to creating phone numbers, Javis allegedly told the professor some duplicated numbers among the accounts were acceptable as long as no more than 5 to 7% were copies. Wow, this got sloppy quick because, people don't share phone numbers, right? But it also is an indication that JP Morgan, when did they look at this? When did they notice this? How deeply did they dive into it? Or did they just look at some millennial with a degree from some hotshot college and say, let's just jump on it? Remember, a lot of hedge funds got caught up in the FTX scam. Okay, these are so-called the wizards of smart where finance is concerned. JP Morgan has been bitten as well. Listen, don't end up like JP Morgan. Don't get so enthusiastic about something that you don't read the fine print. If they had somebody take the time to go through this and, really examine it, they would have seen that, wait a minute, this data is not making sense. Physical addresses proved to be one of the biggest sticking points due to the complexity of creating unique addresses, according to the lawsuit, with the professor at one point allegedly telling Javis they were, quote, wasting too much time on the address thing, unquote. Early on, let's get paid here. Let's not get too deep in the woods. They're not going to look at it anyway. Early on in the process, the professor allegedly told Javis he was having trouble finding believable addresses. Should I attempt to fabricate them? He asked. That's a quote. Javis answered, quote, I just wouldn't want the street to not exist in the state, unquote. So at the end of the day, Javis sold the company for about $175 million. And the professor, who, basically has risked his freedom at this point, how much do you think they paid him? $13,300. So he was that dumbass turtle that agreed to take the scorpion across the river, and the scorpion stung him midway through. And he said, why you do that? Well, I came to you with a fraud here. And what are you going to do, at this point? I've paid you $13,300. You accepted it. You're in there with us, buddy. So this professor, I don't know what he's thinking. He's not very smart to be a professor, because he gave them an invoice with line items of each fake information field he created. So Javis said, no, buddy, you got to redo that invoice and just put the line item as data analysis. And guess what? He got a bonus for that. He got about $5,000 more dollars. So he got $18,000 for, maybe he can keep some of it for his commissary account when they throw his ass in prison, which is exactly what's going to happen. Now, will this sink JP Morgan's ship? Absolutely not. It is a hell of an embarrassment. But it's a blip on the radar with regard to the amount of assets that they have under their belt. And if you want to know, should you run for the hills right now and get your money out of a bank? Well, just consider this. The banks do have the FDIC protection of up to $250,000. So you've got that. But keep in mind, that doesn't mean if your bank goes insolvent, they're going to cut you a check. The FDIC is going to cut you a check the next morning, okay? There are all kinds of actuarial tables in there that complicate that issue, okay? It's not as cut and dry as the little sticker you see on the bank door. Now, with regard to banks, how much money, should you really have a lot of money in the bank in the first place? We always say no. You should be able to manage your bills, but why are you holding money in a bank that's paying you far, far less than the rate of inflation? You're getting 1.5%. Inflation is around, conservatively speaking, 8%. Come on, you got a big gap there in terms of the difference between what that bank is giving you and what you're having to spend at the grocery store. And if you want to make money with a bank, listen, what you should do is either do your due diligence and maybe invest in one, or open your own bank. And yes, you can do that, okay, using insurance policies. We've talked about that a lot. We'll talk about it more. But look, never take anything for granted when it comes to a bank. Lehman Brothers was out there for 158 years. Bear Stearns, a century. And, hey, look what happened there. Okay, check out this report we did on the gold IRA. Is a gold IRA all it's cracked up to be? Is all that glitters gold when you're talking about a gold IRA? We do an honest review, let you know what the facts are. It's important that you don't lose money. Watch that video. Make it just a part of your due diligence. And guys, I'll talk to you soon.